Welcome to this explainer. Today we are diving deep into Phase E, inventory control and valuation. You can really think of inventory management as this super high-stakes mission where your company's chaotic, fast-moving physical warehouse has to perfectly mirror its neat, orderly digital financial records. Because honestly, when those two realities, the physical boxes and the digital numbers, start to diverge, it's basically a recipe for absolute catastrophe. So today we're going to look at exactly how to prevent that disconnect. Consider these 5 steps your ultimate survival guide for inventory. We'll be hitting movement discipline, tracking and estimating, executing the perfect count, valuation, and finally tying it all together with the period end close. Let's get into it. All right, starting us off with Section 1, movement and system discipline. I want you to imagine walking right onto a busy warehouse floor. Forklifts are zooming by, boxes are flying off shelves, trucks are backing into the loading dock. It is chaos. To maintain any kind of order, you absolutely need a golden rule of inventory control, and it's this. No physical movement happens without a matching same-day system transaction. If a box moves from a rack to a truck, the system needs to know about it that very same day. Because without this discipline, your perpetual inventory record collapses almost instantly, and you are literally flying blind. And this strict rule applies to every single type of daily movement. It's not just about sales. We are talking about internal location transfers, supplier returns, which, by the way, always require a debit memo, and customer returns, which have to be quarantined and carefully inspected before they're ever restocked or scrapped. You've also got consignment inventory. This is a big one because it's tracked entirely separately. The consignee doesn't actually own it, even while it's sitting right there on their shelves. And of course, there's FIFO rotation, which is enforced physically at the picking face to ensure your oldest stock is always shipped first. Moving right along to Section 2, tracking and estimating inventory. Now that we've got physical movements down, we have to look at our tracking systems. On one side of the ring, you have the perpetual system. This provides continuous, real-time updates at every single receipt, transfer, and sale, which immediately identifies shortages. It is an absolute operational powerhouse. On the other side, you have the periodic system. This one only calculates quantities and costs at period end after a physical count, leaving these huge, dangerous blind spots during the period itself. Cost of goods sold just becomes this residual math figure. Because of that massive risk, here's a strong warning. The periodic system is highly risky and generally not recommended for manufacturing or really any company with significant inventory. But what happens when you desperately need an inventory value, but a physical count is just impossible? Let's say you're in the middle of a quick interim reporting period, or worse, you're filing an insurance claim after a disaster. Well, that's where estimation methods step in to save the day. A great example is the retail inventory method, which relies on a cost-to-retail ratio. To pull this method off, you just follow 3 very actionable steps. First up, determine the cost-to-retail ratio by dividing total goods available at cost by total goods available at retail. Second, multiply your ending inventory at retail by that new ratio. And third, you arrive at your estimated ending inventory at cost. It's a really elegant bit of math that gets you out of a tight spot. But keep in mind, an actual physical count is absolutely still required at least annually for verification. Now, there is another estimation technique out there called the gross profit method, which calculates estimated cost of goods sold from net sales. But I have to give you a critical warning right now. The gross profit method is for estimation purposes only. Sure, it works great for quick back-of-the-napkin math, but it is not acceptable for financial statement purposes, and it will absolutely fail an audit. Keep it far away from your official books. Okay, on to Section 3, executing the perfect count. Eventually, all those estimations have to step aside for a physical reality check. This is the moment where the physical universe forces your financial ledger to tell the complete truth. But you don't just count everything all at once randomly. Smart operations use ABC classification to strictly control their financial risks. Let's break it down. A items make up the top 20% of items by annual dollar value. They often represent like 80% of total inventory value, so those get counted monthly. B items are the middle 30%, counted quarterly, and C items, the bottom 50%, are counted just annually. You've got to prioritize counting the assets that matter the most. And this brings us to a really crucial operational insight. Cycle counting, using that ABC framework we just looked at, replaces the absolute chaos of a full annual count with continuous verification of a rotating subset of inventory. This is a huge, game-changing operational advantage. Errors are caught within weeks rather than months. And the best part? you don't have to completely shut down your entire warehouse to get it done. However, when you do have to execute a full physical count, which usually happens at fiscal year end, it has to be done under tightly controlled conditions. You literally have to freeze the environment. Production is paused, and all movements are completely halted. Think about it. If you don't freeze movements, a worker might count an item, move it to another aisle, and bam, it gets counted again. Suddenly, your assets are dangerously inflated. Oh, and you must use strictly pre-numbered tags so you can prove exactly what was reached and counted. And here is the ultimate safeguard of the whole counting process. Independent count teams must never see the system's book quantity before completing their blind count. It's just human nature. If a counter knows the system says there should be 10 boxes, they're probably just going to confirm 10 boxes without really checking thoroughly. Blind counting forces an honest, independent number and totally prevents lady reconciliation. Once the counting is wrapped up, we hit the count reconciliation process. If the physical count and the book quantity fall within an acceptable tolerance, boom, it's accepted. If it's outside that tolerance, you've got some investigating to do. You'll want to look for timing errors, like maybe items shipped right during the count window, or system errors. You also have to look for genuine shrinkage, which means theft, damage, or evaporation. You should even be tracking variance patterns, like say the same items always going missing on the same shifts to catch systematic theft. And remember, any adjustments above materiality absolutely require formal management approval before that ledger is adjusted. Which brings us to Section 4, valuing what you have. So confirming your physical quantity is completely useless if the carried financial value of those goods on your balance sheet is totally wrong. That's why the LCNRV assessment is absolutely crucial. It stands for lower of cost or net realizable value. Net realizable value is basically the estimated selling price minus estimated cost to complete minus estimated selling costs. Under the rules, inventory must not be carried above its NRV. You actually have to run this test at every single reporting date, not just year-end, actively hunting for things like technological obsolescence, physical damage, or a sudden collapse in customer demand. If that NRV drops below your cost, you got to write it down immediately. Now, pay really close attention here because this is a massive divergence. If you do have to write down inventory, GAAP and IFRS handle the exact same economic event drastically differently. Under US GAAP, the write-down establishes a new lower cost basis, and no subsequent recovery is recognized ever. But under IFRS, they use an allowance account. So if the market miraculously turns around, a reversal is permitted up to the original cost. Knowing which framework you are reporting under is literally make or break here. For items that are showing signs of impairment but haven't been fully written off quite yet, management will often use an obsolescence reserve matrix. This is based strictly on how long items just sit there gathering dust. Items 0 to 90 days old generally carry a 0% reserve. But as they age, that reserve climbs. 91 to 180 days might require a 25% reserve. 181 to 365 days hits 50%. And once it's over a year old, management might reserve 75 to 100% of the value. These are estimates, reviewed at each assessment date to ensure the balance sheet stays grounded in reality. And finally, we've reached Section 5, the period end close. To tie this whole shebang together and close the period cleanly, you have to check off several critical reconciliation items. First and foremost, the inventory subledger must perfectly equal the general ledger. Every single difference has to be investigated and resolved. Next, goods in transit where title has passed must be accrued. Consignment inventory must be confirmed entirely separately, and any open production orders lingering beyond their expected cycle time, those need to be validated, for sure. Another vital step in the close is managing your GR/IR account. That stands for Goods Received Not Invoiced. You have to clear this thing monthly. If you've received goods but haven't been invoiced, or maybe you've been invoiced but haven't gotten the goods, it just sits right here. Investigating any balance that's been sitting in this account for over 60 days is absolutely vital to prevent a really dangerous backlog of lingering liabilities on your books. Well, we've covered the strict movement rules, the tracking systems, the precision of a physical count, the rules of valuation, and those final critical checks of the period end close. But honestly, it all comes down to this one question. Do your company's digital ledgers perfectly mirror its physical reality? Or is there a financial disaster currently hiding on your warehouse shelves? I highly recommend taking a closer look at your own inventory operations and seeing what you find. Thanks so much for joining me on this explainer, and keep learning.